Ladies and gentlemen, good day and welcome to Q3 and 9 months FY22 earnings conference call of V2 Retail Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantee of future performance and involves risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manju Tandon, CEO. Thank you, and over to you, sir.
Okay, thank you. Hi, good afternoon, everyone. A very warm welcome to our Q2 and H1 FY22 earnings conference call. I hope you all are staying safe and healthy through this unusual and challenging times. Along with me, I have Mr. Akash Agarwal, Executive Director, Mr. Gaurav Bansal, our new Finance Head, and our Investor Relations team. I hope everyone has had an opportunity to look at our results. The presentation and press release have been uploaded on the stock exchanges and our company's website. So let me start with the key updates. The company opened one new store during Q3 FY22. As on December 31st, the company operates 97 stores spread across 15 states and 84 cities with a total retail area of 10.23 lakh square feet. Same-store sales growth for the Q3 FY22 stood at -3%. Now allow me to give you an overview and our operational performance during the quarter. So first I'll give you a consolidated performance highlight for Q3 FY22. For the quarter, revenue from operations stood at 239 crores, registering a growth of 5% on YOY basis. Gross margin stood at 33.4% for Q3. The stores were operational on an average for 98% days of the total days for Q3. EBITDA for the quarter stood at 41 crores as compared to 44 crores in Q3 21. EBITDA margin stood at 17.1% for Q3 FY22 as compared to 19.2% Q3 FY21. PAT for the quarter stood at 12.3 crores as compared to 14.9 crores in Q3 FY21. Now I'll give you performance highlights for 9 months FY22. Revenue from operations for 9 months stood at 471 crores, registering a growth of 35% on YOY basis. Gross margin stood at 33.5% for 9 months FY22 as compared to 34.4% for 9 months FY21. EBITDA for 9 months FY22 stood at 70.4 crores as compared to 60.6 crores in 9 months FY21, registering a growth of 16%. EBITDA margin stood at 15% for 9 months FY22 as compared to 17.4% for 9 months FY21. PAT for 9 months stood at 2.2 crores negative as compared to 2.6 crores negative in 9 months FY21. The quarter witnessed strong demand in the festive season of October and November. However, demand tapered sharply post December 15th until January 22 due to restrictions imposed by various state governments in the wake of the wave of COVID. We are again seeing consumer sentiment return to normality since beginning of February 22 as the national infection caseload came down. We are hopeful that the recovery shall be sharper on the onset of festive and wedding season in the coming months. All the stores are now fully operational with overall store operations days at 98% for the quarter. Our customers continue to increasingly leverage the convenience of our digital platforms with the online channel. Our expansion plan on store is on track. Some delays due to pandemic. We are planning to open additional 5 to 6 stores in Q4 FY22. Our emphasis on the private label continues and the growth is encouraging. Health and safety of all our customer and employees are paramount importance and all required precautions are being adhered to. We are confident that the business has the expertise and importantly the resilience to weather this crisis. Given the underlying business fundamentals and the balance sheet strength, the company is well poised to embark on a new wave of growth and create for all stakeholders. With this, I now leave the floor open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Priyanka Trivedi from Antique Stock Broking. Please go ahead.
Yeah, thank you for the opportunity. My first question is with regard to the gross margin. So the gross margins have contracted on year-on-year basis. So what has led to this contraction as we have been increasing our share of in-house production? So what has led to this decline?
Yeah, so if you look at the 9-month number, the gross margin has reduced by about 1%. So, because there was COVID in April, May and June, we lost a big proportion of our festive days where there's a wedding season. So we didn't want to carry over that inventory to FY23. So we had put an extra discount to liquidate the inventory. So it is because of extra discounting and also because of the slowdown post 15th of December, we had put early discounts on winter wear and pre-winter garments as well. Because we wanted to liquidate inventory and go into the new season with as much less carry forward inventory as possible. So these two things contributed to a 1% contraction in the gross margin.
Has there been any impact of input price inflation on our gross margins, or have we taken any price hikes?
So yes, there has been pressure and the raw material prices have constantly been increasing, but we have transferred most of that increase to the customer itself, and that is why we are looking forward to maintaining our gross margins at 32% going forward. So whatever increase in the raw materials and the input prices will be transferred to the customer and will lead to higher prices.
Okay, got it. My second question is on our store additions for the quarter. So we have added one store. While if we look at the other peers, they have been aggressively adding their stores, especially in this quarter. So what has been the reason for just adding one store? Because we have been very aggressive on our outlook for the stores.
So we did not want to delay our vendor payments, and our cash flow, because of COVID in the summer, it didn't allow us to expand, as much as we wanted. So we delayed the expansion plan, and now we are back on track, and hopefully COVID is over. So we are adding about 5 to 6 stores in this current quarter, and going forward next year we'll add about 25 to 30 stores.
Okay, got it. And lastly, if you could just give us a sense on, how has the recovery been in urban versus the rural? Just lastly on that commentary, that's it.
So October and November was very encouraging for us, and we were seeing SSG, positive SSG from pre-COVID levels. But the second half of December actually was very poor. I think it was also because the winter wasn't cold enough in December, and the onset of winter was pretty delayed this year. So I think that is why the quarter from pre-COVID levels was about -3%. But it was very encouraging, and I think Omicron has just given a free booster shot to most of the people. So I feel we are very positive going forward, and because there's a lot of pent-up demand as people have not been freely going out for the last 2 years. And I feel next year will be, one of the best years in the last 2, 3, 4 years.
Okay. Yeah. Thank you.
Thank you. The next question is from the line of Deepak Poddar, an individual investor. Please go ahead.
Hi, Akash. First of all, congratulations on good set of numbers. I have few questions. First is on the CAPEX. So what was the CAPEX for first 9 months and full year CAPEX look like? And also for FY23.
Yeah, so as we opened only 3 stores this year. So there wasn't much of CAPEX requirement because the CAPEX requirement per store is about 1.1 to 1.2 crores. So when you talk about FY23, we are planning to open about 25 new stores. So the CAPEX requirement will be anywhere between 30 to 35 crores.
And how are we planning to fund that CAPEX?
So we will be generating an EBITDA of about 80 to 90 crores next year. So it will be funded by internal accruals.
So no debt required, correct?
No debt required.
Okay. And since we are planning to open 20 to 25 stores next year, my question is, how much time does a new store take to break even?
So, we have had a very mixed batch in that, because a lot of stores took about 1 year to mature and reach its peak levels. A lot of stores took 2 years to reach its peak. But if you talk about operational break even, then the store starts breaking even from the first month of operation itself.
Okay. And what would be the break even levels then?
The break even level so the operating expense of a store is anywhere between 120 to 130 rupees per square feet. So the break even level is about 400 rupees per square feet of sale.
Okay.
I'm talking about breaking even at the store level without any head office cost. Okay. And if you add the HO cost, then the break even level increases to about 500 rupees per square feet.
500 rupees per square. Okay. And follow-on question on the expansion. Which geographies are we planning to expand?
So we have already signed most of the agreements, and they are already they are mostly in the clusters that we're already operating in, because in terms of transportation, marketing. So we are opening new stores and finalizing new stores in regions where we feel that we have a strong brand presence in, and historically where our older stores have done well.
Okay. And on the e-commerce expansion, what was the e-commerce sales for first 9 months, and what would be your guidance for FY22 full year and 23?
Yeah, so the e-commerce sales was 21 crores for the 9 months. It was about 4% of our total sales. And for next year, we are targeting a sales of about 50 crores from e-commerce. So right now, what we are trying to do is, start omni-channel. So we are investing in technology, where the technology that will enable us to, deliver some stores. So that testing is going on. So I think that will further reduce the logistic costs for us. And going forward, the target is to maintain 4 to 5% of sales, a good sales mix from online from the online channel.
So 4 to 5, as you mentioned, 50 crores. Traditionally, this e-commerce business requires cash burn. So what is the competitive edge we have, and have we burned cash till 9 months?
So, on the sale of 21 crores, you can say the cash burn was only 50 lakhs, because most of our e-commerce cost is variable cost, and that most of it goes into logistics and marketing. So that is why we don't want to burn a lot of cash. That is why we are, gradually understanding this new channel, because it's a new, environment for us. So we are trying to understand how to increase the marketing returns, ROAS, and how to reduce RTOs, how to reduce customer returns, and how to optimize inventory, how to optimize logistics, how to get faster delivery for the customers. So we are working on all those things, and investing in AI technology and tying up with third parties to understand the data better. So I think there won't be any significant cash burn even to achieve that 50 crores, because as I said, most of it is variable. So the only investment will go into technology, so that would be about 1 to 2 crores for e-commerce.
Thank you, Akash, for answering my questions. If I have any more queries, I'll join back the queue. Thank you.
Thanks a lot.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi Akash. Good to speak with you again. So first question is, what is your guidance of fiscal year 23, assuming it's a normal year without any COVID-related disruption?
Yeah, so we plan to open about 2 lakh square feet new area in FY23. So from existing stores, we have about 1.1 million square feet already. So we close next year at around 1.3 million square feet, and we're targeting a per square feet sale of about 725 rupees per square feet. with a gross margin of 32%. And the expenses that we are forecasting is about 170 rupees per square feet. So if you calculate it, it comes to around 1,050 crores of turnover, sales turnover, with an EBITDA of about 85 crores. So that is our target for next year.
Okay. And my second question is, in terms of debt, what is the current position and what will it look like by the end of this year?
So currently the debt is around, I think, 47-48 crores. And I think going forward, by the end of next year, it will reduce to about 25 to 30 crores.
By the end of this year?
By the end of next year.
You're saying next year, okay. And then in terms of inventory, so are we totally current on our inventory, or is there still some old inventory that needs to be either marked down or discounted and sold?
So we've already liquidated most of the inventory. That is why you're seeing a lower gross margins, and we've taken some extra provisions because of COVID. So all those provisions have already been taken, and I don't think any extra write-offs or provisions need to be taken now.
Okay. And in terms of the competitive intensity, if you can give some color about what's happening to some of the other regional players or smaller players in your market, that would be really helpful.
Yeah, so there is definitely increased competition from the national players, like Reliance and Max and Tata. They are expanding aggressively, but there has been less competitive intensity from the regional players. But like I said, I think the consumption is will keep increasing, and the rural middle class will keep expanding. So I think there'll be space for at least 4-5 very good, strong players. So I think it's all about who gets it right in the next few years.
Mm-hmm. So when you compare your SSG for Q3, I don't know if you have done this, but how does it compare to, let's say, the website guys, I'm sorry, I'm forgetting the name of their competitive brand, and with respect to V-Mart?
I wouldn't want to comment on any other company's numbers, but our SSG, I think, is at par with the industry average, and I think it's very encouraging that it's the SSG was -3 from pre-COVID levels, and that too, it was because of December. So I think we can easily get a positive single-digit SSG from to pre-COVID levels in FY23.
Okay, great. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. My question is an extension of the point that you made while answering the earlier question. So see, it's always we see that there's a lot of demand in market, and a new player will expand the market or demand in general. But then now the influx of competition has been huge in terms of we were battling with all the regional competitors for a while, and now suddenly we have all the national players, as you rightly said, they are very aggressive and they are getting into even 3 lakh or sub 3 lakh population towns as well. So 2 questions here. First, what is the value proposition they bring as a product or as an experience to the table versus ours? And what is our right to win that the consumer still continues to prefer us over the national brands which are lending so much comfort on brand and retail experience?
Yeah, so to answer your first question, the national players that we were talking about, for example, Reliance Friends, their ASP is above 500. And even if you talk about Max, their ASP is about 450. So we feel that, with an ASP of about 290, that we cater to a different class of customer. And, there's a very slight overlap between a Reliance Friends customer or a V2 customer. So I feel, like I said, if we make our niche and if we are able to target that class of customer, then there is space for, like I said, 4-5 good players at least in the value proposition. Because still there's a huge vacuum in terms of value retailing in India, and still the organized retailing contribution is negligible, and most of it is mom and pop stores and unorganized retail. So that share will keep decreasing, and people will start coming to, like organized players will start getting those that chunk of the pie. So I feel if we are strong enough and if we focus on assortment and product development, it's all about the product offering by the end of it. So I feel like the product and the pricing will be our biggest USP, differentiating ourselves from everyone.
And so you spoke about Max and Reliance, but if we say Zudio is almost competing with almost similar price point that we offer, right?
Yeah. So Zudio's average store size is only 5,000 to 6,000 square feet. Our average store size is 12,000 square feet. So with Zudio, I can definitely provide double the number of options to my customer. So if I'm able to, provide a more number of options and at a better pricing or a better product assortment, then like I feel like we can do much better numbers.
Sure. That's all from my side. Thanks and all this.
Thank you. The next question is from the line of Ankit Babel from Shubhkam. Please go ahead.
Yeah, good afternoon, Akash. A few questions from my side. First was, what was the figure of the operating days in Q3? I missed that number.
98%.
98%. Okay. And what was the share of own manufacturing in Q3, and what are your plans to take this to in the upcoming festive or the wedding season in Q1?
So in Q3, the contribution was about 15%, and the plan is to take it to about 35% in FY23.
35% in FY23. Okay. And what kind of impact can it have on your gross margins?
So it is definitely giving us benefit in terms of costing, but going forward, like I said, we want to target a gross margin of 32% consolidated, and because of higher input prices, we might pass the half the effect to the customer and absorb half. So it'll set off with the saving that we are getting from the factory, because we want to focus more on being competitive, having that competitive advantage rather than having a higher gross margin. So getting a higher gross margin in order to focus, getting a higher per square feet sales, and turning over the stock more time. That is the target.
Okay. And what was the inventory level at the end of Q3 at consolidated level, and what was it last year, corresponding period?
1 second. For Q3, it's about 270 consolidated, and for V2 retail, it's about 248 crores. Last year numbers I'll have to check, but we have been able to reduce inventory from the last quarter. So I think we've reduced it by 40 odd crores. And going forward, we want to target an inventory days of about 90 days. So if we have a sale of 725 rupees per square feet, it translates to about 2100 rupees per square feet of stock.
Okay, so 1 second. So you're targeting that on 1,000 crore revenue at 90 days, it comes to around 250 crores of inventory. So you believe that you'll do a revenue of 1,000 crores with the same absolute amount of inventory which you currently have?
Yes. That is why for the additional area also, we don't need additional working capital for the inventory. We're going to rationalize this existing inventory level and operate an additional 2 lakh square feet.
So can you give us some idea how you are going to achieve this? What efforts you are taking, or what will lead to such kind of reduction in number of days and keeping the inventory at the same level with higher revenue?
One of the things that we've done is we've reduced the density at a few of our slow-moving stores. So we have rationalized the display inventory that was there at all our stores. So that has reduced from about 800 rupees per square feet to about 670 rupees per square feet. So that is the first thing that we've done. And second that we are doing is we have increased the frequency of deliveries to our store. So the replenishment cycle has changed. So that has enabled us to maintain, lesser number of days at the store. So these are the 2 biggest changes that we have done. So I think we've already seen the result, and we've reduced the inventory in Q3, and further going down further down the line we'll be able to achieve 2100 rupees per square feet of inventory.
So reducing the density, can it have an impact on your PSF?
Till now, we haven't seen a negative impact, because what it essentially does is it increases the freshness index of the store. Because whenever a new customer comes in, he sees more fresh stock. So we saw that we did not have any negative impact on sales.
Okay, that's it. Thank you.
Thanks.
Thank you. The next question is from the line of Sagar Parekh from Deep Financial Consultants. Please go ahead.
Yeah, hi. Thanks for taking my question. Actually, my question was just going by Ankit's question on the gross margins and our scale up of our own production, the business model that we are trying to achieve. So, just curious to know that if you're expecting your sales per square feet to go up significantly once you have your own production, then why would you just expect about 700 to 725 rupees sales per square feet? Because that was, I believe, the number which we have done, I think, pre-COVID also, right? So either the sales per square feet have to significantly move up, or your gross margins have to significantly move up. Because if you do your own model and your SS sales per square feet does not go up, then it doesn't make sense, or your gross margins have to go up. So either of the two has to go up.
Yeah, Sagar, it's very rightly said. And like I said, the production, it's a very gradual business to actually get the fruits of. So product development, we started about 1.5 to 2 years back. But, there were a lot of learnings and there were a lot of lessons learned. And when we give a forecast to investors, we always give a conservative plan. Of course, we have a very aggressive internal plan as well, where if our production, does is efficient and does at par at what we actually foresaw when we started production, then we would easily achieve 800 rupees per square feet. But right now, the target is 725 rupees per square feet with a gross margin of 32-33%. And the extra benefit that we are getting from production, like I said, because we want to kill the competition, because we want to get more market share, because we want to gain that competitive edge, we want to pass on that benefit to the consumer. Because if the consumer feels he's getting the same product at V2 at a cheaper price, because V2 has been able to get a cheaper costing on it because of own manufacturing, then I want to get that customer into my store. So I think it's all about gaining a market share for the next 2, 3, 4 years, getting a good foothold in the market, rather than getting a high gross margin. Once we feel that our brand is established and people know, people connect with our private label, then would be the right time to actually make it a cash cow and increase the gross margin.
I get that, but still, I mean, in terms of, I think the difference between our own production and third-party purchase was about, I think, 8 to 10%. So even if you take like 4 to 5% absorption or 4 to 5% price pass through to the customers, and you take the benefit of the half of it. Still, I think we used to do 32-33% gross margins in the past. So. And we used to do similar 700, 725 rupees sales per square feet. So we are coming back to the same kind of numbers that we spoke about, I think, 2 years back. So it's just not adding up. So
you can say that because of the competition intensity, earlier our EBITDA targets used to be 10, 11, 12%. But
correct.
Now that target has gone down to about 8%. So I think that should answer your question, because right now a lot of new players are also coming in the market. So the market environment is not same as before. So right now the conservative target is to target an EBITDA of about 8%. And of course, like I said, if the products that we are manufacturing, if it's implemented well, then it can easily increase the EBITDA from 8 to 10, 11%. But we don't want to go give those kind of numbers to investors until we feel ourselves that the product development and the manufacturing new products are proving themselves and we actually foresee it. So I think it's too early to make that call. So we need to give manufacturing at least 1 more year to actually see what kind of results it's getting us.
And then going forward, where do you see the own manufacturing business, settling down at 50 to 55%, or in 2 to 3 years it can directly go to about 100%? Because I think in the last call or the call before that, you had mentioned that this is just like a setting an example to other vendors to set up their own shop and do it at something like that. You had mentioned, if I remember it correctly.
So if we increase the turnover, the manufacturing percentage will keep going down because we don't plan to open more manufacturing units. What we'll have is we'll have contract manufacturing, and we'll have manufacturing partners that will only exclusively work with us. You can call them manufacturing franchisees. So the idea behind having our own manufacturing unit was to ascertain the efficiency when negotiating with those kind of vendors, so that we can show them that, see, we are able to achieve this costing. So, that is the contract we want to work with you on. So that was the whole idea behind it. The manufacturing percentage won't go up going forward. Only this year it will go up because obviously the efficiency was low last year, and we plan to increase that efficiency. So increasing that efficiency will increase the production. But going forward, the target is to have 100% private label selling in our stores, but the production contribution will keep coming down every year.
Sure. So by when do you think this 100% private label contribution would be reached? Would it be possible in FY24, or it will take beyond that?
I think it should take another 3 to 4 years. We have reached about 50%, and gradually, I think for FY23, the target would be about 60 to 70%. But there are a lot of categories that we have still not, had private labels developed yet. So by I think the next 3 to 4 years, we can be above 90% private label.
Okay, sure. That's it, Akash, from my side, and all the best.
Thanks.
Thank you. The next question is from the line of Pankaj Pant, an individual investor. Please go ahead.
Akashi, good morning. Just want to bring an incident to you. Am I audible?
Yes, sir, I can hear you.
Okay. Sometime back we heard that you had opened a store in Dehradun, and I was very keen to visit it. I checked with Google Map. You were not to be traced. I checked with Facebook. It said, yes, you have opened one in Dehradun, but I had no inclination, no address, no phone number, nothing. I sent a query also, nobody responded. I tried calling Haridwar, Roorkee, but those numbers were not working. What I'm trying to say is, the presence was not clear. You are there. Eventually, I visited after a couple of weeks. I was able to get the address. It's a nice place, quite big by Dehradun standard. And V-Mart is already here with 4 or 5 showrooms, probably maybe more, because I can count 4 as I speak to you. So I understand that you are trying to fight. V-Mart is one of the competitors, and you have made a presence in Dehradun, but the visibility is not there. And considering social media is very competitive, so that presence should be marked. And I think that is the cheapest mode of promotion. So just wanted to bring it to your notice.
Thank you, sir. The point is well taken. So we do have a Google business account, and we do tag all our stores on the Google map. So I'll definitely take it up with my team and see where there was a lapse and correct it as soon as possible.
Yeah, just wanted to bring it to your notice because I don't know about other stores in other cities. But in Dehradun, I was not able to find it for a couple of weeks. And considering, I think it is a good market with competitors with their 4 or 5 store or maybe more.
Yes.
So probably I think it's the cheapest mode of publicity, your sales team or someone can just do.
Because we do a lot of digital marketing, hyper-locally in a radius of about 15 kilometers from our stores. So to enable that, we do have to put the location of our store on Google and Facebook. But I'll definitely check why you couldn't find the store, and I'll correct it as soon as possible.
Yes, I felt because if the new kind of products which you keep coming out, like the reason you gave just now, you have disposed of the inventory and you plan to have new inventory for the wedding season. So probably the sales team or the marketing team, they can flash the new design into Facebook page and other mediums, and probably they may translate into sales, and it won't cost much. Yeah, that will be all.
Thank you.
Yeah, thank you so much.
Thank you. The next question is from the line of Bhavin, an individual investor. Please go ahead.
Hi, Akash.
Hi, Bhavin.
Akash, is kind of a repetitive question, but much more focused on Q3, given the fact that the trend always suggests that Q3 happens to be a best quarter, right? So just wanted to know what led to subdued margin profile for Q3, because surprising given the fact that you've clocked in terms of revenue, there's been a growth, but margins have taken a hit, especially in the best quarter, which has been a trend all throughout.
Yeah, so like I already said, because of the lockdown for 3 months during the summer, we had a lot of pile up of festive wear, which we knew that will not sell at full price in the next wedding season. So we took a decision to liquidate it because we wanted to enter FY23 wedding season with as much fresh inventory as we could. So it was a conscious call, and we knew it would lead to lower margins. So one reason was that, and the second was because the average temperatures being very high in the regions that we operate in during December, we saw that the footfalls and everything was very affected, and we saw huge degrowth towards the second half of December. So we decided to put early discounting on pre-winter and winter goods, because again, because it will be very hard to sell that goods in the next year, pre-winter, winter. So I think these two were the biggest reasons that it came down. But if you look at the 9-month number, it's just a gross margin reduction of 1%.
Right. So does it affect, means when I consolidate and when I probably calculate the yearly numbers put together, will it affect the yearly margin profile if someone needs to project it across?
No, I think going forward, like I said, the margins will be maintained at least 32%. So there will not be any anomaly, except hoping that it's a COVID-free next year. So I think going forward, minimum gross margins will be maintained, yearly gross margins of 32%.
And if I consider Q4 performance, means as in obviously it's just been 1 month or 1.5 months, has there been any impact for the third wave in this particular quarter especially?
Yeah, so most of our stores are in Bihar, and Bihar was the most affected in terms of restrictions and lockdowns. So most of our stores were affected in January. But now, thank you to the government for realizing that lockdown and restrictions were not the answer. And with the cases coming down, most of the restrictions have been lifted now. And February, we are seeing the customers coming back to the stores, and I think it'll come back to pre-COVID levels once the festive season kicks in. So for FY23, we are looking at a positive a single-digit SSG from 2019 levels, pre-COVID levels.
And in terms of the Q4, especially, how do you see the impact majorly in terms of if I need to put a number to it?
So I think in Q4 last year, we had a loss of 10 crores. So I think the numbers should be better than last year.
Okay. That's it from my end. Thank you so much.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
We have seen a lot of people having bigger stores.
Sorry, but your voice is not clear. I'm not able to understand.
Yeah.
Hello?
Yeah, is it clear?
Yeah, better.
Yeah. So we have seen a lot of people, having bigger stores from what traditionally we had around 10,000 square foot store. And we are seeing people now expanding to, 12, 15,000 kind of store to get better revenue. So what is your thought on that in our store side?
So I think, the store size has a lot to do with what location it's located in and what kind of a customer, density that area has. So one of my stores is 30,000 square feet. It's still doing much better than the national average in terms of per square feet sales. And so I don't think store size determines the performance of the store. It has a lot of other external factors that needs to be decided in terms of store size. But one benefit of having a standard store size is when you're doing your assortment planning. So it really helps in getting the purchase plan for all the articles. But otherwise, the location, the kind of customers it caters to, the population density, and the frontage, those kind of things determine what size your store should be.
Okay. And on the branding side, what will be our goal for next 2-3 years? Kind of, are you increasingly trying to spend on the brand, and because competition is hotting up, so are you trying to is it viable to spend on the branding and create some brand for ourselves, or no?
We feel the product is the biggest brand ambassador for us, and that is what we are investing most on. Because if you talk about Uniqlo, if you talk about Primark, it's their product that sells. It's not, even if you talk about Zara, they don't go big on marketing. So I feel we want to strengthen our product first, and that will give us the biggest advantage, more than any marketing or branding campaign. But of course, to get the customers into the store and just see the assortment that we have.
And post-COVID, how are we seeing on the rental side? Are they softening, or they are back to pre-COVID? Sorry.
So all the concessions that we got because of COVID, I think they're over, and the rentals are back to pre-COVID levels. So I think our rentals are about 44 rupees per square feet, and going forward, it's going to stay at the same level.
And for the new stores, which we are opening, like 25 stores, which we will open,
more or less at the same level.
Okay.
The cost structure.
And anything on the cost structure we can tweak, still we have some gap to do, or anything which we can help us for long run to improve our margins?
I think we are at industry best in terms of per square feet cost, because even in this quarter, the per square feet cost was about 168 rupees per square feet. So I don't think there's a margin there to further reduce costs without having a negative impact on sales. So I think even with this cost structure, we can get the EBITDA targets that we are looking forward.
Okay. Yeah. Thanks a lot, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Ankit Babel from Shubhkam. Please go ahead.
Akash, just a follow-up. In case if we don't achieve our desired level of PSF of say rupees 725, are there any levers to maintain your EBITDA margins? If yes, what are those?
No, like I said, the cost is already consolidated and already saturated in terms of there's no margin to further reduce costs. And I don't think if we are not able to achieve the sales per square feet of 725, so we'll have to take the decision quarter to quarter. So if we feel in the first 2 quarters we're not able to achieve that sales number, then maybe we'll take a decision to pass on less of the benefit to the customer and increase the gross margin of 1 or 2%. But like I said, right now the plan is to get a gross margin of 32% and a PSF of 725. But like we always do a monthly review where we see the budgeted numbers versus actual numbers, and then the decision can be taken and implemented. So there's only one way you can achieve that EBITDA by gross margin.
Any such move of retaining the profitability will make you more uncompetitive, right? Because if you pass on benefit, you become more competitive, and if you retain it, you become less.
I wouldn't say if we become less competitive, but we come at par. Like if we increase the price and don't pass that benefit to the customer, then the price comes at par with our competitors. So we don't gain any competitive advantage, but we don't lose any as well. So I think that will be a scenario where we feel that, these goods are not giving us an extra per square feet sale. So, we can increase the gross margin. But that's a hypothetical scenario, and it'll be done when we review what kind of performance we do in Q1 FY23.
Okay. And I'm again missed that number of cost per square feet. What is it? 160 or 170?
It was 168 in this quarter, but going forward, we're taking at 170.
170 rupees we should model for FY23, right?
Yes.
Okay. Okay. And what is the share of private labels now in your portfolio, and where do you see it going forward?
It's about 45% right now, because of COVID we didn't plan a lot of winter wear, so that's why we couldn't increase the private label margin contribution. But going forward, I see it at about 65 to 70% for FY23, and in
for the year as a whole,
about 90%.
3 to 4 years, 90%. Okay. And any further investments required in your own manufacturing?
No. The only capex requirements is in technology, but that's not for manufacturing. I'm just talking about the company. So the capex requirement will be for the new stores that we want to open next year. It'll be about 2 to 3 crores will be in the supply chain, the warehouse for automation, and about 5 crores in technology.
So your current manufacturing capacities can take care of what part of revenue?
About 30 to 35% for FY23 numbers.
Okay. So beyond that, expansion would be required, right?
Like I said, we don't want to expand into more manufacturing units. Beyond that, it will all be done by job workers, the contract manufacturers. So we have a lot of units that want to work with us. The only problem was the costing, but now we can show them the actual costing that we're getting in our factory, and even if you give them a return of 12%, they are willing to work with you. So it's all about efficiency. So even till now, we have only achieved an efficiency of 60% in our manufacturing. The target is to achieve 70%. That will further reduce the cost by 3%.
What do you mean by efficiency? Is it the capacity utilization you're seeing, or what?
Oh, the efficiency is basically in manufacturing, there's a standard minute that every garment takes to make. For example, a t-shirt takes about 6 minutes to make. So if your factory is making it in 12 minutes, then your efficiency is 50%. So like factories in Bangladesh, they achieve almost 75 to 80% efficiency. So it's basically the minutes that you're achieving for making that product versus the ideal number of minutes you should take.
Okay. And lastly, on your creditor days, how are they shaping up? And what are your targets there? Creditor days, payables.
Yeah, so average credit days for us is about 60 days, and going forward it's going to stay the same.
60 days. So a 90-day inventory and a 60-day creditors.
Yes, 30-day working capital cycle.
And this is on a consolidated basis, including the inventory which you keep for your own manufacturing.
So the inventory target of 90 days is for V2 retail only, standalone. So if you add that, I think it will increase to about 95 days.
Okay, because earlier I remember, because of your own manufacturing, your creditor days used to come down because you are no longer getting credit on the own manufacturing. So considering that, what would be your net working capital cycle?
So like I said, the working capital has already been employed in V2 Smart in the subsidiary. So there will not be any additional requirement. So I wasn't including that working capital when we spoke about the 30-day working capital cycle.
No, but you still get that 60 days of credit days in spite of increasing share from manufacturing?
A lot of vendors are at 90 days. So the average comes out to about 50 to 60 days, even if you include the cash payment done to V2 Smart.
Okay. Okay. Yeah. That's it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rajesh Jain from G Anand and Research. Please go ahead.
Hi, Akash. Thank you for the opportunity and congratulations for the good set of numbers. My first question is related to rent cost. Did you pay full rent during this third wave lockdown, or is there any reduction? And second question is related to the sales mix. Can you explain what are the shares of ladies, men, kids, and other general merchandise?
Yeah. So first, talking about rent, because 98% of the stores were operational during this period, so we did not have any rent concessions in Q3. And rent concessions were only during the lockdown, which happened in April, May, and June.
Mm-hmm.
And about the sales mix, the men's category contributes about 42% for us, and ladies and kids contributes 25% each, and general merchandise contributes 7%.
Okay. Thank you. All the best.
Thanks.
Thank you. The next question is from the line of Pulkit Dharmawat from Wilshire Advisory. Please go ahead.
Yeah. Good afternoon, and thank you for giving me the opportunity. So the question that I would ask is, what is the average selling price and average bill value?
Or you talking about 9 months, or you talking about the third quarter?
The third quarter and 9 months as well.
Okay. So for the third quarter, the average selling price was 341 rupees, and the average bill value was 870 rupees.
Okay.
And for the 9 months, the ASP was 296, and the average bill value was 800 rupees.
Okay, thank you. And the another question that I would like to ask is, what is the regional mix in the total sale?
The regional mix, so East contributes 54% of our sales, North contributes 30% of our sales, and South contributes 16% of our sales.
Okay. Thank you so much. Thank you.
Thanks.
Thank you. The next question is from the line of Deepak Poddar, an individual investor. Please go ahead.
Yeah. Hi, Akash. You mentioned that inventory level is 90 days and creditor 60 days. This is for Q3 FY22, or this is what you want to achieve going forward?
No, this is what we want to achieve. Right now, I think the paid stock is more than what we want in our books, but I was talking about the targeted numbers.
Okay. So what is the current inventory number? Absolute number?
248 crores.
And how much of that would be winter wear? Obviously, going back to your one of the answers, that most of the areas wherein you are located were under lockdown, and that coincides with the winter season. So is there any inventory currently now which we are carrying on from the winter part of it?
So it's insignificant. I think winter wear inventory, leftover inventory is less than last year because, like I said, we put early discounts this year, and that had a negative impact on our margins, but we were able to liquidate most of the winter wear and pre-winter inventory.
Okay. And so you mentioned 240. What is the thought process or what is the steps which we are taking to reduce those inventory levels, overall inventory levels?
Like I said, we want to maintain these levels, but we'll be able to operate 2 lakh additional square feet area with the same inventory levels. So that is the target. So we are opening 5 to 6 stores in this quarter itself, and then we'll open about 25 stores next year. So we'll be leveraging the same inventory.
Okay. Any additional provision, inventory provision, which we would have taken this quarter, like we were taking in earlier lockdown?
Yes, we took an extra provision this quarter also, because there was another lockdown in the summer, and for old aging inventory, we took an extra provision, and I think no further provision will be required, and everything has already been accounted for.
Okay. That's it from my side. All the best.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Akash Agarwal for closing comments.
Thank you everyone for joining on the call. We hope we've been able to answer your queries. Stay safe, For any further information, we request you to get in touch with Marathon Capital, our investor relations advisor. Thank you, and have a nice day.
Thank you. On behalf of V2 Retail Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.